All right, so welcome to the demo day on the 8th, I think it's the 8th of January, 2021. I wish I could say that 2020 was well behind us, but it seems to have at least reached into these 7 days for anyone who's been paying attention. All right, so today I want to chat about the an idea I've been working on that I sort of had over the partial holiday that I had over December, and that's the idea of a fully decentralized, tokenized, perpetual long contract against the price of Ether. So we're going to be calling this token the dETH token for now, and we'll be going into some detail as to how it actually ties into the Fry token and just basically how it works. All right, so the first question is basically, what is a perpetual long contract? Right, so a perpetual long contract is essentially a long contract where you go long some security, but then you, through some automated mechanism provided to you either by a broker or by an exchange or by some other service, you basically keep the collateral ratio of the long contract within a certain band. When I demo the product, I'll actually show some aspects of how the underlying parts of it work. And how that's accomplished. So the next question is, do things like these already exist? So as with all things in DeFi, we are perpetually reinventing the decentralized wheel. So there do actually happen to be a few perpetual long contracts already live on Ethereum. The one big thing is just that they are not DeFi native in terms of them being fully decentralized. So there are some tokens from FTX available that actually get managed by FTX, where you can long and short different cryptocurrency tokens. All right. All right. So the thing is, how did we accomplish this? Right. So one of the great things about DeFi, and I think we're going to start seeing this increasingly, is that we can basically just take what people are terming the DeFi Legos and sort of put them together. So basically the first part of the system is MakerDAO, which is the DAO that manages the DAI stablecoin. So MakerDAO's main product is DAI, which its main goal is to track the value of $1, right? So DAI is supposed to always be worth $1, right? DAI basically gets created by people who open what are called collateralized debt positions or vaults. And they do this by depositing some of their collateral, which can be Ether or wrapped Bitcoins or a bunch of other tokens that the MakerDAO decides on, by depositing that into the vault. And so the MakerDAO system then basically tracks the value of that vault and allows them to generate DAI against that collateral up to a certain ratio. If they fall below that ratio, then they get liquidated. As long as they're above that ratio, they can either pay the debt off or they can extend more debt within the ratio.
Yep, and just to clarify something, it's the user can come with Ether, put that into a vault, and then it's the user who then can generate DAI against that collateral. Just to clarify something there, but go ahead.
Yes, it's the user that does this, right? So the backend smart contracts and the settings to that smart contract are managed by the MakerDAO ecosystem. So they set the stability fee, which is essentially the interest rate, and they decide what the interest rate on different collateral types should be, what the debt ceilings are, and basically what the process is of unwinding bad debt. But the rest is all the user, right? So all of the rest of this stuff is user-based. Okay. So then basically another component that came along after MakerDAO started was a project called Defi Saver. So Defi Saver initially kicked off as a method for people who have Maker vaults to just have a better interface to it and to do certain things automatically. So a lot of people who were long Ether basically started opening vaults, depositing Ether, drawing out DAI, and then basically buying more Ether, depositing into the vault again. And then eventually DeFi Saver also included a feature called automation. And with automation, you can basically set the settings for a specific vault. as to what ratios you want to maintain of debt versus collateral, and DeFi Saver's product will actually keep it within that within those bounds for you. I think what I should do now, actually quickly, is just maybe show people the MakerDAO vault system and DeFi Saver. What do you think, Logan?
I would say skip right to the DeFi Saver, show the DeFi Saver graph, and in particular that chart where the boosts and repayment happen. That I think is the key concept here.
Okay, cool. Let me do that thing quickly. All right, so let me hold on. Let me just quickly share screen again here. All right. So get some of the stuff out of the way. All right, so if you go to DefiServer.com, DeFi Saver is a very, very cool application that essentially allows you to automate your debt position. Hold on for me 1 second, please.
Yeah, so maybe just to summarize while Skulk's doing this, unless you're back, Skulk.
Well, okay, I'm back, but I think summarize.
Yeah, so the component so far is MakerDAO, which generates DAI. The way DAI is always generated is a user or some external system comes in, puts Ether in to generate DAI. So then, of course, some users have started to come into these CDPs or vaults. They put Ether in to get DAI, and then they actually just buy more Ether. So then they're long Ether. The risk to doing that, the main risk is that if you're not watching the CDP or the vault and the price crashes too far, then you could default. And so what DeFi Saver, which Skulk's about to show us, does is a DeFi Explorer. Those are the same group, right? Just different URLs.
Yeah, so DeFi Saver is the actual interface, and then DeFi Explorer is the essentially the it's sort of a simulator in a way for you to look at what other people are doing with their CDPs.
Right. So what this DeFi Saver system does, I mean, it does a few different things, but importantly for us, it basically it manages your CDP for you, so you can be long, but it will prevent you from defaulting by, if the price falls, it will, correct me if I get the mechanics here wrong, Skulk, it will take some Ether, buy DAI, pay back some of your debt, and then take the Ether back out to basically refund the Ether it spent on doing that. And then also, yes, if the price of Ether goes up, it will actually rebalance in the other way, so that you are sort of constantly maximally exposed. So if the Ether price goes up, then it can generate more DAI because of that. So it generates the DAI, buys Ether, and redeposits it into the CDP.
Yes, that is correct. That's exactly what it does. So to just give you guys a quick idea of but this is obviously the interface to the back end. But so if we wanted to create a CDP here, for instance, I'm not going to create this as this is on the mainnet. Unfortunately, there's no testnet version of this to demo. But basically, if you went to DeFi Saver at the moment and you went to create Vault, then you'd be met with this screen. You'd be asked for a collateral type. You'll see that they have several different types of collateral. I think most interestingly for most people would be that they have, they've got Ether and they have wrapped Bitcoins. Those are pretty much, the two heavy hitting collateral classes in the crypto space at the moment. All right, then you'd be asked for how much collateral you want to put down. So let's just say, as an example, we want to put down 1 Ether. There is a floor limit, which is part of why I think what we've built on top of this is going to be useful to some people. There's a floor limit of 500 DAI. So you can't really open this if you don't have at least 1 Ether, and you can generate at least 1 DAI's worth of debt. Right. Then what they also tell you basically is that you can lever this
500
right
DAI's
out
worth
the
of debt. You said 1 DAI, but go ahead.
Oh, sorry, not 1 DAI. Sorry, 500 DAI's worth of debt. Right. So Yeah, so essentially what we can do here, you'll see if we mess around with these settings, essentially it tells us what our ETH exposure is. So our ETH exposure, if you deposit 1 Ether and you loan DAI against that Ether and you redeposit it and you buy more Ether, if we select a debt ratio of, well, if we select a debt of about $150,500 here, then we pretty much get a leverage of about 2.19. Right, so now that's, first of all, that's not really as high as you could get on a centralized service, but keep in mind here all the components of this whole thing is decentralized. Right, so literally the only thing coming in really from the outside world here is the price of Ether, because the DAI is decentralized, Maker is decentralized, and the automation process on top of Defi Saver is decentralized.
I would say let's move to the what our contract does, because I think without getting into that, the context is a little bit yeah.
Okay, so I just want to show the all right. So I just want to show that. So this is the, if you go to DeFi Explorer.simulation, right? So I'm just going to say an amount like 100 Ether, for instance.
So this is a simulator. So, this is a simulation.
Yeah, so this is a simulator of how this strategy would have performed. Right, so let's just say we leave it on the default settings we have here. So just to explain what these are, we basically deposit 100 Ethers worth of collateral. We have no starting date, and we're going to run the simulation from essentially the 1st of April, the last day in March. This is a little, well, I wouldn't say deceptive, but it is a little misleading in the sense that if you did include March, which was a very, very negative month, the results here do differ quite severely, but you guys can go check this out. Right, so I'm just going to leave it on the default settings for now, right? So let's say, for instance, we just wanted to maintain a collateral ratio of 200%. In other words, we have twice as much collateral as we have debt, and we basically tell the system that if our collateral ratio drops below 180%, then repay it back up to 200. So in other words, pull out some of my collateral, pay off some of my debt, right? If it goes above 220%, then we basically say, okay, well, make more debt and go buy me more collateral and get me back up to 200%. Right, I'm just going to hit the simulate button here. Okay, that should have run now. All right, so if we look at the simulate button here, so I'm just going to start at this, I'm going to start at the bottom and work my way up here. So at the bottom here, we see these little green things. That's every time the DeFi Saver automation had to kick in to actually like change the, to basically rebalance the collateralized debt position. So that's either when it had to.
And just I'll insert here as well. That's where DeFi Saver makes its money. So every time it rebalances, which Stalk will continue to explain, they take a proportion of that rebalance, and that's how this system survives.
Yeah, so they take a proportion of that. I believe the proportion is 0.3% of the difference. So if they basically had to pay off $300, then they'll essentially take, I think, 30 cents of that $300, right? And they also charge you for the fee. So in other words, the fees that you have to pay to so the gas fees that you basically have to pay to get things working. So essentially, if you look at the bottom here, you'll see how you'll basically see how the strategy performed. So we started off with 100 Ether, and had we run it from April to today, essentially this leverage position would be worth 640 Ether, right? So this is in a period of time when Ether was rallying, which is why the strategy worked. If Ether was decreasing in value, then we would see the same type of accelerated race to the bottom, right? That's part of why we're calling our token dETH, is because if you go in the wrong direction with this thing, it'll bleed you out unbelievably quickly.
And put more accurately, if you get in and the market goes in an unpleasant direction, that's when you bleed out, right?
Exactly, yeah. So the thing here is basically, if you started off with 100 Ether in April, you would now have about 640 Ether. So that's about a 6.4. That gives us about 60. That gives us a 64x US dollar return on investment, right? I mean, that is absolutely insane. That is bonkers, right? Now, again, the problem is basically if the market moves against you, then you're going to end up in a bad situation with regards to that.
All right, I think move on to the dETH contract now.
All right, I think, okay, cool. Can you guys still see this presentation?
Yep.
Okay, give me 1 second. Okay. All right. So this is basically the stack. I've dealt with the stack that this was built on. All right. So some of the benefits of this thing. So what we did was.
Can I make a suggestion here?
Yes.
Let's first summarize the sort of the use case and why we're doing this before talking about the benefits.
Okay.
So what is the dETH contract in like just a couple sentences?
Okay, right. So the dETH contract, basically the dETH contract is it is a tokenization of that automated strategy, right? So what it allows people to do is it allows them to enter with small amounts and to exit with small amounts. There are some constraints to the whole idea of setting up a automated CDP. The first constraint is basically like that you don't get economies of scale. The smaller your CDP is, your gas costs remain the same to settle it in and out, right? And if you have a small CDP of a few $1,000s, that is a significant cost that basically amounts to. Now, DeFi Saver do go out of their way to basically make sure that those costs are under control. But even then, you still do better if you have a larger CDP, and it's aggregated with a whole bunch of other people, right? That's the first benefit that we basically get. The second thing is, I mean, it simplifies the concept, right? If all we basically say is, listen, this is a leverage token, and if you are long Ether, if you believe that in 5 years' time Ether is going to be worth an incredible amount, and you think it's worth very little at the moment, relatively speaking, then this is sort of an accelerated way, for you to basically benefit from that kind of a move, and that's essentially the two serious benefits to it.
Right.
And this token makes that available to a lot more people. Mm-hmm.
Yep. And then so I would say that's the pitch to the user, the end user of this contract. And then if I can add the pitch to sort of the FRI holders, our investors, essentially, is that the dETH contract charges its own fee for entry and exit. So when you put Ether into the dETH contract, you get your dETH tokens. It charges a small fee, and then when you go the opposite direction, it charges a small fee. And that fee will, and we can talk about this a bit later as well. Although I don't know if I want to make the demo day too long, but the putting the mechanics aside for the moment, it buys FRI and increases the liquidity of FRI. So that's how Foundry realizes profit from this whole venture. So to summarize that whole strategy, we're not trying to gamble as Foundry. We're just trying to create a casino essentially for people to gamble. So if we charge on the way in and the way out, then people can take their chances with the market price. Having said that, I am a user of the dETH contract. I think we're in a bull market, so I myself am slowly putting in more Ether into the dETH contract as the contract itself becomes more audited and things like this.
Yeah, so basically just to tie it into FRI holders, what currently happens with the fee is it goes to an address titled Gulper. I am currently trying to figure out all the aspects of the Gulper, but essentially what the Gulper will be doing is it'll take that fee that Logan described. So the contract charges a 0.9% fee when someone mints dETH and dETH and when they redeem dETH, right? So it charges on entry and exit, and that 0.9% fee basically goes to the permafrost for Foundry FRI tokens. Now, what that does is that lifts the price of FRI, that increases our permanently available liquidity, and it's in a high fee pool, which basically further grows our liquidity over time. So some of the benefits just quickly of this thing, the first thing is this contract is completely decentralized. So every aspect of this thing runs in a decentralized fashion, right? Once it's in its fully final form, at the moment, we still have an escape hatch key, which we will burn once the audit is complete as well, which we'll burn it, but okay, it gets a little bit technical, but it'll effectively be completely decentralized. The other thing is very pro Ethereum. So if you are a fan of the Ethereum ecosystem, This thing essentially keeps you as fully invested as you can be in a decentralized fashion, I think. It's very pro-Ether, so the token of Ether, you definitely have accelerated exposure to price movement of Ether. It's pro-DAI and it's pro-DeFi, right? Because it's all, the whole thing end-to-end is built with DeFi Legos, right? So some of the risks I do want to make clear is, the first thing is the adverse price movement. Essentially what happens here is if the price of Ether doubles, then over some period of time, the price of dETH would essentially quadruple. But in the same way, in the opposite direction, if the price of Ether halves, the price of dETH would essentially go down to 25% of the price, of its price before the move. Yeah, so that's the one risk. The other risk is fee churning. So in a market where we're basically moving sideways, the result will basically be that that as it bounces up and down, it consumes fees, and that fee basically has to be taken from the collateral amount. So it constantly is draining the collateral amount actually of the position. So in a market where it goes down or sideways, it's definitely not ideal. The other thing is, it's not as aggressive as a fully centralized long, but that's a risk profile people can figure out for themselves. Another problem is basically liquidation. If there is an event where the price of Ether moves more than, I think, about 25 or 30% in 1 hour, which has only happened once in the history of Ethereum, then there is the risk of this underlying CDP being liquidated. There's some smart contract risk. If anything breaks in MakerDAO, then this thing is at risk. If anything breaks in Defi Saver or its automation, then this thing is at risk. And if anything breaks in our smart contracts, then this thing is at risk.
Well, just a question.
Do you have anything on yours? Sorry, yes.
Can you just go back and just explain that bit again about when ETH goes up 100%, the dETH token goes up 4x or 3x, 200%. So it's an accelerated increase, but it's a slowdown. It sounded like a slowdown, retarded decrease in the dETH token price. Is that right? That's what you said.
How do you mean it sounds like a retarded slowdown?
No, well, I think what you said was that if the price of ETH goes down 50%, the dETH token only goes down 25%. Was that what you said?
No. The dETH token would go down to 25%. So in other words, if Ether moved down 50%,
it'll go down to 25%.
Okay, so this is not exactly how it would pan out. Due to the fact that there's a lot of play in the amount of collateral that's available, so it's not exactly going to pan out this way. It's just to give you an idea of the order of the move. So in other words, if the price of Ether basically doubles, then the underlying collateral to the dETH contract would likely also double. But because the underlying collateral has doubled and because the price has doubled, the price of the dETH token is now essentially 4 times higher than it was before that move. Okay. Conversely,
Okay, I didn't understand when you said down to 25%. I took it that you meant that it would drop by 25%, which didn't make sense. But what you're saying now is exactly the way I understand it. So it's an accelerated move in both directions. 100%. Gotcha. Thank you.
Exactly. Yeah. So that's kind of why I've decided to run with the name dETH, because it should make it obvious that there are some economic risks to this thing.
But you keep saying dETH. We gotta just call it dETH. I'm telling you.
Well, okay, then the dETH contract. Yes.
DETH contract.
Okay,
Plus,
we're almost,
way more fun to talk about in a car
for this.
Yeah.
We're almost out of time for this thing, so I very quickly want to just get into the actual demoing of the smart contract. All right, give me 1 second. I'm gonna share again now. Just want to open up that backend.
I'll talk a bit more while Skulk's setting that up. So this project we're working on doesn't actually need an interface like most of our other projects, because what we're expecting to happen is, as we launch this, whales that are used to arbitraging will know how to use a smart contract, and then they can actually generate the dETH by putting in their own ETH, and then in fact move that token to dexes like Uniswap, and then just sell the token on Uniswap. So that's how we can push this out relatively quickly. We're still waiting on the audit, though. That's going to be, I think, the main holdup at this point.
Yes. The audit is the yeah. So we have an auditor looking at the code at the moment. He did come back to us and say that like the preliminary view of the layer we built doesn't have any obvious problems, but there are some deeper issues that he needs to inspect in that regard. And he is also
to be clear, there's not deeper issues. He needs to look deeper in the stack 4 issues, just to be clear.
Yeah, he needs to inspect the issues more deeply that could be there. But,
right.
So that's kind of like where we are with the situation at the moment. Okay, so I will share this in the show notes as well, this link. But essentially, if you go to our contract, well, like I said, please don't just randomly go to a thing called levered ether on Uniscan, on Etherscan, Uniscan. See, too many of these names are now melding into one in my brain. All right. If you go to the contract and you click on the contract part, you click on the right contract piece. If you scroll down a bit, you will see an aptly named function called squander my ETH for worthless beans. Right, and what the squander my ETH for worthless beans contract does, let me just make sure I'm connected to something that has some ether in it. Okay, I am going to actually, and this is real, so I am going to mint some real dETH tokens for myself on mainnet. Let's just copy that. Okay, so basically this contract already, or this address already has some dETH tokens in it. Let's just have a look there exactly how many it is. All right, so it currently has 3.434 dETH tokens. So I'm going to mint 1 ether's worth of dETH tokens. So while this mines, I'll just quickly describe what it does.
You're doing 0.1 ether. I'm guessing that was intentional.
Oh, sorry. Yes, I'm going to do 0.1 ether. All right, so basically, while this mines, I'm just going to describe what this is doing in the background. So this now takes my 1 ether.
0.1 ether.
Sorry, my 0.1 ether. It takes my 0.1 ether. It determines how much of the excess collateral in the CDP would 0.1 ether account for, and then it issues me proportionally that amount of dETH tokens. Right. So, for instance, let's say there was 100 outstanding dETH tokens, and there was 10 ether underlying. Then if I add 0.1 ether to that collateral pool,
10 ether as free collateral, just to keep consistent
as free
with the
collateral,
terms.
As free collateral, then I'll essentially then I should get, because I'm adding 1%, I should get 1 dETH token out. Let's just actually look if this got mined. All right, so okay, so if we just inspect this, for those of you who understand how this stuff works, we'll actually just see here that the tokens transferred. We'll see that, okay, well, some ether got transferred. So 0.0991%, 0.991 ether actually got transferred into the Maker system. And what got transferred out back to my address was 0.929 dETH tokens. So let's see if those actually got assigned.
Man, you're really having trouble with those digits there, Skulk.
What did I say? 0.
It's fine. You said 0.09, but
normally my excuse for lingual problems is that English is my second language, but this is math, so I don't know why I'd get this wrong. Okay, so all right, so you'll see that I now have received a little bit of extra of the dETH tokens.
And just
If
a
I
note,
want
just
to-
a note on that real quick. If you're going to do this yourself, you will have to manually add the token to track it in MetaMask. So and we can help you out with that. But just so you don't freak out when you see that there's nothing showing up in MetaMask, you just have to tell MetaMask to track a custom token.
I think what we will do though is just write a very, very minimal interface to add the token to your, to your MetaMask and to just mint and burn. I think that might be something small, but that's a little bit down the line. Our initial plan for this is to launch it via Uniswap. Okay. All right. Now to redeem some tokens. Now I'm going to redeem exactly one dETH token. I'm just going to select 18 decimal points here and just make sure that I send the redeemed Ether to my own account. Confirm that.
You might notice the gas fee is pretty exorbitant.
Yeah, the gas fee is pretty exorbitant, right? So by the way, there's no front running risk on participating in this contract. So if you want to set the gas very, very low, that's perfect. That's no problem. It will it'll process when it's ready, and it'll give you a fair amount of dETH tokens, and you can't be front run. All right, so let's go view this transaction. All right, still mining. Whew, yeah, no, that's a steep gas price right there. So part of the reason why we believe this is a good product idea is just that it, as high as these gas costs might seem, the gas costs for actually opening, automating, and closing your positions on MakerDAO are actually like considerably higher. Like for instance, at about similar gas costs on Monday morning, I paid $541 to close a specific position. Okay, cool. All right, so essentially, okay, so that transaction that we just saw, that concluded here, and you'll actually see that my one dETH token has now.
That's the other one. That's the first one. That's not the exit, is it?
Yeah, no, this is the exit.
It is. It just, okay, right.
Yeah. Yeah, so you'll see here that there was exactly one dETH token that got burnt. That's just what that log indicates, and then there was 1.066 Ether that it was redeemed for. Yeah, and just FYI, when I launched this contract, it launched at exactly, well, it actually launched at 0.991 Ether per dETH. So this is basically due to the little rally that we had, right? So the returns obviously will depend quite heavily on when you join and when you exit. And I'd say probably one of the best times to mint dETH is right after a serious correction in a bull market. And one of the best times to redeem dETH is right after a massive rally, seems to be correcting. All right, so guys, any questions at this point?
So you were saying that the whales would just come and make use of this contract. So they would take out your tokens and put it on Uniswap, and they would be just earning the fees, right? And as a end user, like if I want to go into like a leveraged long Ether position, I would go to Uniswap and buy and swap for these tokens, right?
Yeah, so as an end user, the idea is that this is just another token purchase for you. You don't care about the cost.
Yes, yes. But the value proposition is that this token is leveraged against Ether mathematically.
Yeah.
Okay, cool. I want to ask, so this tokenizes your CDP, right?
And it automates it and tokenizes it, yes.
Yeah.
The layer we add tokenizes it, yeah.
That tokenizes one particular CDP, right? Mm-hmm. So and then the parameters are chosen by you, like how much, like what percentage and stuff, that's already chosen by you.
Yeah, so the parameters at the moment are so the parameters at the moment are 170%. If it falls below 170%, it gets repaid up to 185%, and if it rises above 200%, it gets paid back down to 175%. That's the and it's a ETH type A vault. The ETH type B vaults, unfortunately, at the moment can't issue more DAI until there's a vote by Maker. But what the thinking is that this specific the dETH contract, what we'll do with it is we'll basically we'll run it, we'll test it, we'll see how it operates, what it does and stuff, and then if we see that there's like clear demand for it, or at least even moderate demand for it, we'll probably make it so that we sort of can make a factory where somebody can create their own TDP and then essentially through the factory have their TDP automated and then tokenized, right? And then maybe even automatically listed on an AMM. So for instance, James, if you had a more aggressive set of settings that you feel would perform better, then you could make James dETH, for instance, and and then essentially issue that as a token, and then again, whales can do the same type of arbitrage we suspect will happen in this first version of the token. We haven't quite sussed out all the details of how we'll do that going forward, but that's kind of like the longer term direction we're thinking in.
Right. Yeah. So so this is just like an MVP essentially, where we hard coded some of the things just to see if the base idea itself has demand once it's audited and everything.
So the factory concept you mentioned, so I would imagine like having like a two-dimensional token, like, the dETH token, but for another CDP and yet for another CDP. So it's like a two-dimensional thing, but this is not possible in Ethereum, right? So one would have to essentially just copy and paste your code to their automated CDP in order to tokenize their CDP, right?
Well, we would make it a lot more convenient, basically. They'd be running it out of, how can I say, sort of out of audited code, but maybe I don't quite understand the question or the objection correctly there.
Yeah, so, what if you make a garden of CDPs with different parameters, and in Ethereum, there's no way to have all of these tokenized tokens under the same name, right?
Well, no, you can't have them under this.
I think I have a good response to this. So the Y-earn, I think, is a great example of what we might see happen with the dETH contract. So you have Y-earn, then you have Y-DAI, and I don't actually know how many other ones there are, but they came to this convention where when you have a token and you put a Y in front of it, it indicates a particular kind of DeFi mechanism. And I'm actually not sure what that mechanism is. I haven't really dug into it, but I suspect something similar with the D could happen here. So you'd have dETH and dBTC. And then now I don't think that quite answers your question, because I think you're asking more specifically, what if there's 20 dETH contracts and they each have different parameters? It's hard to see how that will play out, what standards emerge, but there's not really a problem at a technical level. Etherscan can have as many tokens that call themselves dETH as they'd like. And then I suppose we would just have to kind of, in real time, address any confusion that arises and kind of make it up as we go, as far as standards and naming. Does that help answer the question?
Yeah, so yeah, I think, so that means there's no standard or automated way to do it. So it's like the stock market. If you have 10 funds from the same company, you might expect a similar stock symbol, something like that.
Well, the thing is, I mean, it depends on what what part of the exposure you want, because the thing is, we can issue multiple of these derivatives at different settings. But if you want exposure to people getting in and out of if you want positive exposure to the demand of these kinds of derivatives, I would say the simplest is just to buy FRI, because essentially in that regard, you will you'll basically be partaking in the fee and the value accumulation of the decentralized tokens.
Right.
So in other words, the Fry token, are you aware that well, we're building a DAO and that we have a token?
Yeah, I took out some Fry with that like ICO contract.
Oh,
I
okay.
wasn't sure, you know, how. So now you are building value on top of that token now. So.
Yeah, so we're building several products on top of it.
Yeah, and so the best way to describe that whole sort of conglomeration of concepts. So we are Team Toast. We're a very small group. Our main goal is Foundry, which of course has the Fry token, and things like Smoke Signal and this dETH contract. When we work on it, we basically say, well, can this make money for Foundry and Fry holders somehow? Which ultimately is the question: can it take a profit and send a profit back to the treasury, or can it buy Fry and sort of limit the supply? And if yes, then we work on it. And so this dETH contract is just another example of that. And then one day, to finish all up, we'll have to build governance, which we hope to have done by the end of the initial sale in February 2022.
Okay, that's very cool. Thank you.
Any other questions?
Any other questions? Does anybody else have anything else?
I don't think so. I think it's I think that's it. I don't see anything else in the chat either.
Okay. All right. Well, yeah. So lots of anyone who's interested, I can add you to just ping me basically privately, and I can add you to the little dETH group that we have just for this initial sort of beta version.
The dETH group.
The dETH group. You know, where all the cool kids hang out.
Yeah.
And then I can include you there. I think our next steps now is. Yeah, we are going to have a little bit of a discussion there about how safe we feel the contract is, and if we can open up a Uniswap pool for it yet. Yeah, and then just have some discussions about how maybe to start off like very limited trade on the thing as it is now. So yeah, that's it for demo day today, guys.
Yeah, and I think as far as a timeline sort of estimate, as far as I understand, Skulk, things should be pretty developed by early next week, right? We should have some more information on the audit, and you should have the gulper and some of those related solutions pretty much sorted by early next week. Would you agree with that?
Yeah, I think that's reasonable.
Okay, cool. All righty. Okay, well, I think we can end it here then.
Yeah, thanks very much, everyone.
Okay, thanks.
Guys.
Bye.
Bye.
Cheers.
Cheers.